A 69-year-old retiree walked into his bank expecting a routine transaction. He had been a customer for more than 3 decades. The tellers knew his name. The branch manager had helped him open accounts years earlier. He wasn't applying for a loan. He wasn't disputing a charge. He simply wanted to withdraw part of his savings to pay for a major home repair after storm damaged his roof. The money was in his account. The balance was more than enough. Yet instead of receiving his cash, he was told there would be a delay. A review had been triggered. Days turned into more days. Bills continued arriving. Contractors wanted payment. Stress began replacing confidence. What shocked him most was not the delay itself. It was learning that the bank's decision had been made long before he walked through the door. A computer system had already flagged his activity as unusual. Most Americans believe that once money is deposited into a bank account, access to it is guaranteed. They assume that as long as they are not involved in criminal activity and have done nothing wrong, their savings remain completely under their control. Unfortunately, the modern banking system is far more complicated than many people realize. Financial institutions today rely heavily on sophisticated monitoring systems that constantly analyze customer behavior. Every withdrawal, transfer, login, purchase, and account change becomes part of a digital profile. The system learns what is normal and what is not. The problem is that retirement often changes financial behavior dramatically, and when behavior changes, the system pays attention. Many seniors are surprised to discover that turning 65 can place them into a category that receives additional scrutiny from financial institutions. The reason is simple. Older Americans are targeted by scammers more than almost any other group. Criminals know retirees often have substantial savings, retirement accounts, pensions, and home equity. As a result, regulators, banks, and financial organizations have spent years building systems designed to detect potential financial exploitation before money disappears. The intention is good. The goal is protection. However, systems designed to stop fraud sometimes struggle to distinguish between a scam and a perfectly legitimate transaction. Imagine spending 30 years making the same types of purchases every month. Your mortgage is paid off. Your spending is predictable. Your pension arrives regularly. Then suddenly you decide to help a grandchild with college tuition. You transfer several $1,000s. To you, the reason is obvious. To a monitoring system, the transaction may appear completely different from your established pattern. The software doesn't know about your family conversation. It doesn't know about the tuition deadline. It only sees a transaction that doesn't resemble your previous behavior. That difference alone can be enough to trigger a review. One of the biggest triggers involves large withdrawals. Most people assume there is a specific dollar amount that automatically attracts attention. In reality, many systems focus less on the amount itself and more on how that amount compares to your personal history. Someone who regularly withdraws several $1,000s may experience no issues at all. Another customer who normally withdraws only a few $100s could attract attention by requesting an amount that seems unusual relative to their previous behavior. The system isn't necessarily evaluating whether the transaction is right or wrong. It is evaluating whether the transaction appears different. Another major trigger involves changes in technology. Many retirees receive new phones, tablets, or computers from family members. They begin using mobile banking for the first time. They download new financial apps. They access accounts from unfamiliar devices. While these changes seem harmless, modern banking systems often analyze login behavior alongside financial activity. A new device combined with a large transfer may look significantly different from established patterns. Again, the system cannot understand personal circumstances. It only understands data. Travel can create similar complications. A retiree who normally logs into an account from Arizona suddenly accesses it from Florida. A customer who spends most of the year at home begins traveling across the country. Multiple logins appear from unfamiliar locations. Purchases begin occurring in different cities. While this activity reflects normal retirement travel, automated systems sometimes interpret sudden geographic changes as potential warning signs. This doesn't mean every traveler will experience problems. It simply means that significant changes can increase scrutiny. Transfers between accounts also receive attention. Many retirees move money for legitimate reasons. Some seek higher interest rates. Others consolidate accounts after retirement. Some transfer funds into trusts or investment accounts. Yet when money begins moving rapidly between institutions, particularly newly opened accounts, monitoring systems may respond cautiously. Criminals often move stolen funds quickly because of that reality. Banks frequently examine unusual transfer activity more closely than routine transactions. Another issue that surprises many seniors involves account ownership changes. Retirement often brings major life transitions. Spouses pass away. Families update estate plans. Joint accounts are modified. Beneficiaries change. These events are entirely normal, but they can sometimes resemble patterns associated with financial exploitation. Financial institutions have a responsibility to investigate situations that appear unusual. Unfortunately, legitimate customers occasionally find themselves navigating additional verification requirements during already difficult periods of life. The rise of artificial intelligence has accelerated many of these processes. Banks increasingly rely on advanced software capable of analyzing enormous amounts of information in real time. These systems can identify unusual patterns faster than any human employee. While that technology improves fraud detection, it also means decisions are often initiated automatically. By the time a customer contacts the bank, the review process may already be underway. The challenge is that computers evaluate probabilities, not personal stories. This reality raises an important question. If banks are monitoring activity more closely than ever before, how can retirees protect themselves from unnecessary disruptions? The first strategy is surprisingly simple. Communicate before major financial events occur. Most people contact their bank after a problem appears. A more effective approach is contacting the institution beforehand, planning a large withdrawal. Call first. Opening a new account elsewhere. Notify them. Traveling for several weeks. Let them know. These conversations create context, may help explain unusual activity before monitoring systems encounter it. The second strategy involves maintaining accurate account information. Outdated phone numbers, old addresses, and inactive email accounts create unnecessary complications. If verification becomes necessary, financial institutions need reliable ways to reach customers quickly. Regularly reviewing contact information may seem like a minor task, but it can significantly reduce delays during reviews. The third strategy is establishing a trusted contact when available. Many financial institutions now offer programs allowing customers to designate a trusted individual. This person does not gain control over the account. Instead, they provide an additional layer of communication if concerns arise. When suspicious activity is detected, the institution may have another source for confirming that transactions are legitimate. The fourth strategy involves keeping records of major financial decisions. Large withdrawals, family gifts, home repairs, medical expenses, and significant transfers should be documented whenever possible. Receipts, contracts, invoices, and written explanations create evidence that may prove valuable if questions arise later. Documentation transforms a transaction from an unexplained event into a clearly justified financial decision. The fifth strategy is diversification. Many retirees keep all of their financial resources at a single institution because it feels convenient. However, convenience and resilience are not always the same thing. Maintaining a secondary account elsewhere can provide flexibility during unexpected disruptions. If one account experiences delays, access to alternative funds may prevent a temporary inconvenience from becoming a serious emergency. The sixth strategy involves reviewing account activity regularly. Monitoring statements, login alerts, and security notifications helps customers identify potential problems early. Small issues are usually easier to resolve than large ones. Waiting weeks or months to review financial activity can allow misunderstandings to grow unnecessarily complicated. The seventh strategy is understanding that fraud prevention is ultimately a shared responsibility. Banks provide tools, technology, and monitoring systems, but customers also play an important role. Remaining informed about scams, protecting personal information, using strong passwords, and verifying suspicious communications all contribute to financial security. Perhaps the most important lesson, recognizing that financial systems are changing rapidly. The banking experience retirees grew accustomed to 20 years ago is not the same banking environment that exists today. Technology now influences nearly every aspect of account management. Artificial intelligence evaluates transactions. Automated systems monitor behavior. Security protocols continue evolving. Customers who understand these changes place themselves in a stronger position than those who assume everything. The goal is preparation. Most reviews never become major problems. Most transactions proceed without difficulty. Understanding how modern banking systems operate allows retirees to make informed decisions rather than being surprised by processes they never knew existed. The reality is that banks are not trying to take control of customer money. They are attempting to protect customers from increasingly sophisticated threats. The challenge is that protection and convenience sometimes pull in opposite directions. The same systems designed to stop criminals can occasionally create obstacles for innocent people. Knowing this allows retirees to take simple steps that reduce misunderstandings. Retirement should be about enjoying the rewards of decades of hard work, not worrying about unexpected financial complications. A few proactive measures, a few conversations, and a better understanding of modern banking can make an enormous difference. More often, they are the most prepared. Increasingly important role in